With PCE inflation coming in as expected and the economy holding up, are we going to get the soft landing everyone's expecting? Let's go. When we look at this heat map of the weekly, the first thing we notice is that the AI semiconductor trade, it is still on fire. And if semiconductor chips are moving higher, the Qs are moving higher, and SPY won't exactly flop. And software applications continue to put the pedal to the metal, but Apple continues to be a Debbie Downer. So will this hold the market back, or will it shrug it off? And Google got hammered based on its latest picture mishap with AI. And at this point, we're not seeing a whole lot of rotation into consumer defensives, or utilities, or even dreaded healthcare, which tells me to keep taking trades when the good ones signal. Now, obviously, this chart is focused on the S&P 500, and it doesn't look at small caps, but we'll take a peek at that later. As if all indices are pumping at the same time, this would really help us sustain this rally. Next, let's look at the percentage of stocks trading above their 50-day simple moving average for the S&P 500. And let's go ahead and add SPY as a bright green line to this chart. And one thing we're going to look at here is this purple line, which is the 200-day simple moving average. When you're above this line, it's typically bullish, and when you're below this line, it's typically bearish. We can see that in 22 when we spiked through this line and then we got rejected, that if you look at the bright green line for SPY, this was typically bearish behavior. Now, it goes without saying, when we bottomed less than 20% of the stocks trading above their 50-day simple moving average, this was typically a unique buying opportunity. But you'll notice in the not so recent past, even when we spiked through and reversed on this for the S&P 500, even if it was a short-term buying opportunity, it was one. And here you'll even see this again where we spiked through and then we reversed, and then SPY continued to move higher. So recently you see that we spiked on through and now we're continuing to move up higher. So don't listen to all those bears out there telling you that the market has to crash because we're moving higher. Remember, the stock market is built to move upwards a majority of the time. And right now, this isn't showing us anything that is bearish. Let's get a little more confirmation by looking at SPY Weekly. A couple weeks ago, we got this hanging man candle. And the big question was, were we going to reverse? But since then, we just continue to press higher. At this point, the bears are out of bullets. Unless you listen to Ron Walker. I'm sure he's explaining how a quadruple negative divergence is at play and we're going to crash on Jerome Powell testifying in Congress next week. Of course, the bulls will remind us how this week on SPY, we didn't even test this green 5 exponential moving average. And if we look at this light blue line, which is the upper Bollinger Band, which will expand next week, they'll be explaining how there's still room even to the upside. You'll notice a couple red lines on this chart. There's one trend line, and there's also a horizontal resistance line here. If you want to find out more about those, I'll go ahead and link my monthly video that I did yesterday at the end of this one, and you can watch that and find out all about that. With everything looking bullish, there's really only one thing that can keep us pressing higher, and that's by subscribing. Well, I can't promise that it will move the market higher, but I sure would appreciate it. Other than the Qs testing and bouncing off their 5 exponential moving average, everything here looks pretty much identical to SPY, so moving on. Now the Russell, the IWM, is finally showing signs of breaking out. It's been essentially trapped in this trading range for like the last 2 years, and price today finally closed above that range. And right now, if this Russell starts taking off, we're going to have all 3 indices rowing oars in the same direction for the first time in a long time. This chart shows all the algorithms open signals. The algorithm has been really pumping out a ton of good signals, as you can see by all the green on this page. One of which was AMD this week. As you can see, AMD was up close to 15% in a few short trading days. And actually this morning, I sold it in pre-market and then bought it again on the dip. I have a few more key charts that we're going to look at, but if you want to see all my algorithm signals and feedback in real time on 70 equities, then join the Discord by checking it out in the description below. When we look at the US 10Y yields on the weekly, we see over the last few weeks, it looks like they're getting rejected at their 20 simple moving average, and hopefully we see more follow through to the downside. And that's why earlier today, I entered a position into TMF, which is the 3X of TLT, because if we get over this 200-day simple moving average, on TLT, that means TMF, which is the 3x of it, may have some real room to run. As if yields are dumping, bonds will be pumping. A couple weeks ago, the VIX, it put in this beautiful tail candle and got rejected. And finally now we're seeing follow through to the downside. And as traders, we always love to see the VIX getting crushed. Next week, it's all about jobs and of course, Jerome Powell testifying in front of Congress on Wednesday and Thursday. Make sure to watch my monthly video right here, as that's all I have for now until the next video, and we'll see you then.